Tesla shares under pressure after the EV company narrowly missed earnings estimates and warned that its expansion will be notably lower this year. Phil LeBeau joins us right now with more. And Phil, those words notably lower were their words, and I think that's part of the concern.
Yeah, that's the concern, Becky. Also, most people expected, I shouldn't say everybody, but most people expected Tesla to give us some kind of a number in terms of deliveries for 2024. Instead, you got notably lower growth in 24 than in 23. So let's talk about the numbers first, and then let's talk about the outlook. They did miss on the top and the bottom line, but the gross auto margins, excluding the zero-emission vehicle credits, they came in better than expected. 17.1%. The street was expecting 15.7%. But there's the key right there. 2024 deliveries, the company says they will be notably lower. Slower growth in 24 than in 23 in terms of how much deliveries grow annually. When you look at their annual deliveries, they hit 1.8 million last year. They were up 24% in 23. Go back to 22, they were up 40%. Now you're not sure how much they're going to grow in 2024. Here's Elon Musk on the conference call talking about why the slowdown is happening as they transition to the next generation vehicle they plan to build.
The first manufacturing location for this will be at our Gigafactory and headquarters in Austin, Texas. And then we'll follow that up with other locations around the world. Probably the factory we'll build in Mexico will be second, and then we'll be looking to identify a third location, perhaps by the end of this year or early next, outside of North America.
Left unsaid during the conference call was the fact that the EV market overall, for all automakers, it is slowing down in terms of the rate of growth relative to what we saw in 2023. It's still growing, just not as quickly. Tesla finished 23 number one in global EV sales, but in the fourth quarter, it was topped by BYD out of China. And during the call, Elon Musk talked not just about Chinese EV companies, but Chinese automakers overall, and the fact that they are expanding rapidly around the world. They're very good. And if the world, in terms of countries, are not prepared with trade restrictions, that the Chinese are going to demolish. And that's the word that Elon Musk used, demolish the competition. Quickly take a look at shares of Tesla over the last year. The energy storage business, a bright spot in the report, up 30% year over year. But there really wasn't a whole lot to like in this, guys, largely because of how vague they are about vehicle deliveries happening in 2024. How much are they going to grow?
I mean, I guess that's better than making numbers up when it's a pretty hazy outlook. Phil, we were just talking about it off camera. Joe was making the point that if you can't move Teslas, it just is indicative of the EV market overall. You saw some huge growth, some pushes behind it, but this is going to be a very different year for everybody.
And remember, they have a different dynamic in terms of the Gigafactory in Shanghai and the competition that they are facing in China from the electric vehicle companies over there. And the overall market for autos in China has been slowing down. And so you have this capacity that is there that the Chinese automakers are saying, well, first of all, we got to boost our sales at home. Let's force others to cut their prices. And by the way, we still have extra capacity. Let's start shipping these vehicles around the world. That's what he's talking about in terms of the Chinese automakers, not just when it comes to EVs, but the overall market.
In a recent impactful move within the EV industry, Jonas of Morgan Stanley has revised his statement on Tesla's price target, signaling shifts in the market's dynamics. This decision, set against a backdrop of an evolving EV landscape, hints at a more profound change in consumer preference and market forecasts. Today we're going to delve into Jonas' analysis, contrasting it with the broader industry trends, and explore what this means for Tesla and the EV sector at large. Let's dive in.
Nicole Pedalese and Kevin Green joining us this afternoon. Las Vegas Sands will be watching for too. Is kind of a fun wild card name, but of course the highlight here being Tesla, Nicole. And when folks like Ross Gerber, longtime cheerleaders, have kind of soured on it, does give some perspective for a stock in the Mag 7 that is still in a long-term downtrend.
Yeah, I had the same experience because I spoke to Hatem Diab of the same group, Herbert Kawasaki, and he just really seemed like he wants some clarity from Elon Musk and Elon Musk's dedication and drive for this company, and that, you know, there's a time to be excited and then there's a time to deliver those margins, and as they lower prices and the margins get squeezed, is Tesla still going to deliver on ramping it up in Berlin and Austin, and of course we know in Germany basically they had to pause that plant because of what's been going on in the Red Sea. So just some questions, and it's left the shareholders recently to the downside to the tune of about $207 from about $300. So they want some answers today too.
What kind of answers do you think we might be getting, Kevin Green? And do they need to really appease love those guys, both Hatem and Ross, but, you know, when it comes to the broad investing community, do they need to kind of appease everyone here on how they should be conducting themselves in the public sphere? Or if they print a gross margin at 20%, does everybody stay happy?
Well, right. Yeah. Money influences a lot of people, Oliver. I think if they are able to perform from a fundamental standpoint, I don't think that the street's going to really mind what's happening in the social sphere here. I would say automotive gross margins is going to be the main focus that I'm going to be looking at here. The estimate right now is at around 18.5%. If you're looking at X leases, it's at around 17.9%. If they can get above that particular bar, I think that's going to be bullish for them. But if we do see a low 17% print for gross margins, I think that might spell a little bit of trouble for Tesla. But from a technical standpoint, we should potentially see a little bit of a bounce here if they're able to appease the street from a fundamental standpoint.
$207, $200 roughly is the low from October before the market started to bottom. So, I mean, Tesla's basically like back where it was before the whole market turned around. What do you think technically would matter here, Kevin, particularly to the downside? Is it that 200 level?
The $200 level is going to be the technical level that everybody's going to be looking at. It's already trading below its 200-week moving average, and it does not sustain under that level for too long. Actually, the longest it's been under its 200-week moving average over the last 6 years, 7 years, or what have you, has been 4 weeks. So once again, there's a technical signal that we could see a bounce here, potentially, if they're able to provide the right numbers. We are actually seeing some of the numbers across the tape right now here, Oliver. So yeah, we are seeing a little bit of a sell-off. Yeah, let's check it out.
$202 right now, so we're inching closer to that $200 boundary. 71 cents on the adjusted EPS is 3 cents below the Bloomberg consensus of 74 cents on an adjusted basis. So that adjusted 71 does miss the estimate. The top line of $25.17 billion also looks to me like a miss. And maybe a decent one. I mean, Bloomberg was looking for 25.9 roughly 25.87. So I think they just double missed, Nicole.
Yeah, in fact, they really did. And this is what the questions are. And it all really stems from how much EV demand is there really? And that is the big question.
Adam Jonas, a notable analyst at Morgan Stanley, has adjusted Tesla's price target from $380 down to $340, a decision that ripples through the market. This revision is not just a numerical change, but it signifies a deeper analysis of the global EV market's current state and its future trajectory. But this latest change in price target is not without its cause. Adam Jonas points to the stalling global EV momentum as a primary driver behind this decision. According to him, there's an oversupply in the market compared to the demand, suggesting a shift in the industry's growth pattern that could impact Tesla's volume and profitability in the coming years. But could this be true? Is the EV momentum slowing down, or is another negative expectation right here that's backed by market trends or facts? Let's find out.
All right, for more, let's bring in Fast Money friend Gene Munster. He's a managing partner at Deepwater Asset Management. Gene, great to have you with us. What is your take on the quarter and your reaction to the stock move?
Melissa, this was the most sobering outlook that I have seen from Tesla when they talk about a step down, a notable step down in growth rates. I just want to put that in perspective. The street was looking for 19% revenue growth in 2024 for this year, and they said it'll be notably lower than that. So it probably comes in at 10%. When I see that, I think stock's down 5-10%. That was my initial reaction. I'm surprised to see where it is The reason why I believe it's holding in is twofold. You highlighted the importance of the gross margin ex credits. I would just add to that, that's the first time in a year that we've seen that improve. And so that is a surprise on the positive side, especially given the ramp of Cybertruck, some of that investment. And second, I think the stock reaction speaks to the conviction of shareholder investor base. And effectively, this comes down to a very simple question. Do you believe that EVs are the future? And if the answer is no, that you think that this is going to take 20 years to get to electrification and autonomy, then you believe the stock should be down measurably, meaningfully, 10% more on this news. But if you do believe in the future, then this punky, soft guidance that they're giving for this year is going to ultimately prove to be noise, because everything that Tesla's doing, building out this next generation vehicle platform, everything that they've done in their investments in autonomy, all of that is coming at a time where traditional auto is stepping back from these. And so that's the question. If you believe in electrification and autonomy, Tesla's actually in a better position longer term. And I think that the reaction to shares speaks to the conviction, long-term conviction that Tesla shareholders have.
Adam Jonas' forecasts for Tesla's 2024 outlooks are pretty cautious, anticipating challenges in maintaining their previous growth rates. He also predicts a non-GAAP EPS that falls well below $2, a notable dip considering Tesla's past performance. This conservative estimate reflects concerns over volume production and gross margin pressures that Tesla might face amidst a changing market landscape. Hey guys, welcome back to Tesla Tomorrow. The adjustment in Tesla's price target by Jonas is a critical indicator of a broader market sentiment, and it suggests that while the EV maker is still growing, the pace might be slowing down, with increasing competition and market saturation playing significant roles. While this might not be something that Tesla bulls will agree with, this analysis serves as a bellwether for investors and industry watchers, marking a shift from the previously unbridled optimism surrounding the EV market's growth. And of course, there were market reactions to those predictions. As we carry on with this video, we're going to explore what these reactions were to Tesla's stock price target, and we'll also analyze the broader EV industry and how it all affects Tesla and its stock. So let's get in with it. Before we carry on though, if you're liking this type of content, hit that like button, subscribe, and turn on post notifications to keep up to date on everything going on with Tesla. The market response to Morgan Stanley's revised Tesla price target was swift and noteworthy. Investors and industry analysts scrutinized the implications, understanding that such a move from a leading financial institution reflects broader industry trends. This decision also reignited discussions about the sustainability of the rapid growth that the EV markets experienced in recent years. In 2021, about 6.6 million EV purchases were recorded, from 3 million a year earlier. This significant difference in numbers represents an increase in demand for EVs, which may signal a massive shift towards clean energy. In the past decade or so, the demand for EVs has increased tremendously. Now more than ever, people are buying and using them. This shift towards EVs has bolstered investor confidence, as Tesla bulls believe that the increase in the use of EVs will have a positive effect on the Tesla car sales and demands, and consequently Tesla's stock. However, the overall EV industry is currently facing a nuanced landscape. There's a clear shift towards eco-friendly transportation. Customer preferences are also diversifying. A significant trend is the rising interest in hybrid vehicles, seen as the practical middle ground between traditional and electric vehicles. This presence is also a pretty big shift, and it suggests a more gradual transition towards fully electric vehicles than previously anticipated.
Beyond the creative license of cinematic analogy, well, how about because it was at $299 in July of last year, and now it's at $208? Maybe because it's worth $663 billion now, well off the $1 trillion goalpost that we want these companies to have, or at least as tilt to? Doesn't help that Tesla stock has fallen 16% year to date. By comparison, standout NVIDIA, well, look at this, 21%. The other five, they're all in the black. Look at these numbers. Look at that number. It says it all. Or maybe in 2 days, when Tesla reports, we'll discover that the electric vehicle business has peaked and the solar business isn't going to make up for it. In the last few months, we've seen a host of ailments to the Tesla story, and it's gotten harder and harder to turn a blind eye to them. We ignore it, but we shouldn't anymore. Flagging sales in China versus other Chinese manufacturers, BYD overtaking them as the largest electric vehicle maker in the fourth quarter sales. Possible U.S. saturation, boutique pickup truck that is only going to challenge the F-150 in sales anytime soon. And let's not forget the declining value of the cars themselves. As we learned from Hertz, which owns a huge fleet of Teslas. It's an untold story. It's one that deserves more press. These electric vehicles are not keeping their value the way that we thought they would.
Aside from the shift towards hybrid, the EV market is also grappling with challenges like supply chain disruptions, raw material price volatility, and evolving government policies worldwide. And these factors contribute to the complexity of the landscape when it comes to predicting the growth and impact companies like Tesla will have on the market, and they're also known for their aggressive growth strategies. As a result, analysts like Adam Jonas are adopting a more cautious stance on the EV market, indicating a period of recalibration and adjustment. However, despite this cautiousness in Jonas' prediction, the analyst still values Tesla's core auto business at $75 a share, implying that the revised price target also accounts for other segments like energy solutions and potential revenues from FSD capabilities. And this holistic approach emphasizes the diverse factors contributing to Tesla's overall valuation. You see, the financial implications of Adam Jonas' revised price target for Tesla expand beyond mere stock valuation. They underscore a potential shift in Tesla's financial health and production strategies, which are crucial for investors and market observers. Tesla's gross margin, a key indicator of financial health, are a key focal point for this when it comes to analysis. First up, Jonas' projections of a decrease in these margins suggest Tesla may face increased production costs or pricing pressure, possibly due to the competitive or challenging landscape of the EV market. Also, Tesla's production strategy is equally under the microscope. To maintain its market leader status, Tesla must navigate the delicate balance between ramping up production to meet demand and managing operational costs effectively. But the current market dynamics also are marked by an oversupply of EVs and fluctuating consumer demand, which complicate this task. Jonas' analysis implies that Tesla will need to adjust its production volume, aligning it more closely with the actual market demand rather than its ambitious growth targets. And while this strategy could actually only impact Tesla's profitability in the short term, it also opens up opportunities for the automaker to streamline operations, to focus on innovation, and possibly explore new markets or segments within the EV ecosystem. The car company's response to these challenges will be critical in determining the future trajectory in a market that is increasingly competitive and unpredictable.
It's Tesla time, and Mr. Ross Gerber rejoins us to get ready for the report. President and CEO of Gerber Kawasaki Wealth and Investment Management. Ross, your tone on Tesla, despite still being a big owner, has definitely soured over the past year. And reading your notes, it looks like you think the story has kind of formally downshifted into something more negative. Tell me about it.
Yeah, I mean, essentially the fundamental story behind Tesla has changed. And I think investors need to, really take that into account. Not that Tesla is some sort of bad thing, but, from the high growth, very focused EV company that was in a massive global expansion using full self-driving, having energy storage and charging as other growth engines, to now what looks like a much more mature company with a CEO who doesn't actually work at Tesla most of the time, and with many problems now starting to plague them, whether it's issues with supply chain in Europe or Cybertruck launch issues or full self-driving that's not completed, and then generally just not creating any demand. So they're continuing to have to discount vehicles and hurt margins, followed by the CEO asking for a massive compensation package. So I think investors have to weigh all the facts.
What do you think can steer the course back up, somewhere positive this afternoon? Do you think Elon's going to make any effort to try and correct some of this narrative, or is he just so focused on getting as many cars out as possible?
I'm not sure what his mood will be today. Obviously, investors want to hear about progress with, factory in Mexico and Cybertruck and all the positive things that Tesla has out there that, really need to be focused on. That's what I hope we get that Elon, this afternoon. But, there's also a chance we get Auschwitz Elon, who is, dealing with the world's problems and, is unfocused and really, not getting the results that we're hoping for out of Tesla. So we'll see what we get in the conference call. And I think that tone will set the tone for the stock moving forward.
You don't think at all his kind of preoccupations with his public image reflect a confidence that the company is smooth sailing at this point, given how much the peers were bickering with labor this past year, and Ford seems to still have trouble even with some of the F-150 stuff? I mean, I know you're a Rivian guy too, but the giants seem like they're still way behind.
Oh, yeah. I mean, Tesla is obviously in the pole position, and, it seems stupid that they're losing this, dominant position as they continue to, let competitors catch up. Some of the office bought the new BMW EVs and they love them, and they traded in their Tesla for this. And we've had people trade in their Teslas for Rivians. I'm doing that as well for my wife's car. And so a lot of EV owners are looking for alternatives. And part of that is also because Tesla's become so popular, and they're basically Ubers now and such. So the view that Tesla's a high-end vehicle is also changing.
Speaking of competition, the contrasting approaches of Tesla and Ford in the EV market offer a fascinating study. Tesla, long viewed as the trailblazer in EVs, faces new challenges highlighted by Adam Jonas' analysis. The company's strategy has always been one of aggressive expansion and innovation, pushing boundaries for EV tech and production capacity. However, the revised price target for market analysis suggests that Tesla may need to recalibrate this approach, focusing more on efficiency and market demand alignment. In contrast, Ford's recent decision to cut EV production specifically for its F-150 Lightning reflect a different kind of market adaptation. This move, seen as a response to realigning production with current market demand, also indicates Ford's cautious approach in the face of uncertainty with the EV market growth. Despite this reduction in EV production, Ford's focus on hybrids suggests a strategic bet on a more gradual transition from ICE to EVs. And now, we're not implying a preference of one strategy or the other. However, the comparison between Tesla and Ford's strategies highlights a broader theme in the EV market, and that is one of balance between innovation and market pragmatism. While Tesla continues to push the envelope, Ford's more conservative approach underscores the diverse strategies that companies are adopting to navigate this rapidly evolving sector.
Margins, are they going to be hurt by more price cuts?
Look, I mean, we believe coming in that 95% of price cuts were done. They've continued to cut prices.
You've told me that like 3 appearances ago.
Yeah, and look, and the problem is that as they continue to cut margins, last year it was the right move. This year, you got to hold the line. I think you could have around the edges some price cuts. They need to draw a line in the sand that the vast majority of price cuts are done. You're going to have a sub-$30,000 vehicle, we believe, over the next 12 to 18 months. And I think that's the important thing. You cannot keep giving away that margin advantage. That's the important thing that we believe they ultimately do lie in the sand this quarter. And I think that's something that the street's focused on.
He's in a price war with the Chinese, right? I mean, he's already losing or has lost the lead there. So where does this go from here?
I mean, look, in China, this was a record quarter for Q4. So the one thing is, from a demand perspective, that poker move is paid off. I think now when it comes to Tesla, the focus is 2024, you can't continue to cut prices. And I think if margins start to trough, and they talk about that, and upticking from here, I think volume's 2.1, 2.2 million. Then at that point, I think the bottom is in for the stock.
What if the new reality here is just lower priced vehicles from Tesla going forward? And that's just the way it's going to be. Because in an environment of slowing EV uptake, I think it slowed more than people thought. Yeah. Now he's in this battle in China with the competitors there, that there's no other option.
Yeah, and look, and I think for the recognition now, you've definitely seen Bloom come off the rose for overall EVs. We've seen that globally. But the question is, do you want to own a Tesla or do you want to own an EV? I still believe they continue to own the market along with BYD. But now you really have to hold serve in terms of what's happening from a price perspective, because this is all, in my opinion, the reason that we're long-term bullish. It's just the start of the next phase of the Tesla story in terms of autonomous, FSD, the rest of the Tesla story. So we are going through, I view tonight, it's a moment of truth. I think it's going to be a moment. Well,
Again?
It's a moment of truth around margins.
As the EV market continues to mature, its future trajectory remains a subject of keen interest. Growth projections remain positive, albeit with a bit more nuanced understanding of market dynamics. Analysts anticipate a continuous increase in EV adoption, driven by technological advancements, environmental concerns, and policy support. However, this growth is expected to be more measured, reflecting a market becoming more diverse and competitive. Tesla, a pioneer in the EV space, finds itself at a critical juncture, a point where its ability to adapt to market challenges while maintaining its innovative edge will be crucial. Tesla's leadership in technology and its established brand could be a significant asset as it navigates the landscape. The company's strategies in production, market expansion, and technological development will also play a pivotal role in maintaining its market position as a leader amidst evolving consumer preferences and intensifying competition. Adam Jonas' revision of EVs and Tesla's price target reflects the complex, evolving landscape of the EV market. And as the EV maker navigates these changes, its strategies in innovation, market adaptation, and financial management will be crucial in maintaining its leadership in the industry amidst growing competition and shifting consumer preferences. What are your thoughts, though? Let us know down below, and if you want to know more about what Tesla's been up to over the last few days, go ahead and click on this next video on your screen. See you there.